How to spot a liar. If you jumped on Cathie Wood's hype train in 2020 to 3 years later, you would have made 0% return. But most people bought during the hype when the price was high and sold during the fall and lost thousands. Now, Cathie's tactics aren't new. Wall Street has used them for over a century. I'll cover how Cathie's 2020 hype relates to now, explain why she's not the first and she won't be the last, and I'll arm you with the 3-step framework to spot these people that I learnt from Buffett so you don't get played and lose money. I'm Jack Laffin. I've invested over 2,000 hours learning from the world's best and most successful investors. Now I help stock investors avoid losers and pick winners with confidence. In 2020, Cathie Wood was promoting her ARK ETF fund, and it was during the COVID when she had a large captive audience where we're all stuck inside. Broadcasting on social media was with what they were buying and why, and then coming up with completely irrational projections and forecasts. Anyone can come up with a forecast, doesn't mean it's right. So in that 11 months, a ETF went up 350%. But over the next 23 months, it went down 80%, and it was back at the low it was during COVID. Same price, just 3 years apart. Now, an investment in another ETF, QQQ, which is very similarly weighted in stocks in the technology sector, actually outperformed ARK. From 2014 to the start of 2026, it had double the performance. So, people can be deceptive in two ways. So, one is either on purpose by falsifying information and lying. The second being by their own incompetence. So they either can't admit that they know or that they don't know, and so their ego is playing into it, or they really just have no idea what they're doing. An example of this is, I guess, Sam Bankman-Fried's FTX saga comes to mind for me, and literally hearing about them playing video games while they're on an interview with large fund investors. Now, I think Cathie fits into this second type. So I don't think she's actively trying to falsify information. I think she's just way too optimistic with her projections. But I guess her identity is tied to the success of her fund, and being right is part of it. And so what are we actually seeing now? We're seeing a big social media campaign with Cathie at the front, pushing these overly optimistic messages. And going on one of the largest podcasts and saying this could 15x in 5 years. It's really just appealing to people's greed and their fear of missing out, or FOMO. And it really just is a get rich quick kind of scheme. And it all sounds too good to be true. And two, she's not going to be the first, and she won't be the last. So Wall Street's been doing this for years. In Seth Klarman's book, Margin of Safety, he explains a few key ideas. Idea one. So the IPOs where the underwriter and the stock promoter are actually incentivized to sell the stock for as much as possible because they earn commission or a total percentage of the total value of the IPO. So why do you think most IPOs actually underperform the market after? Well, they were too expensive at the IPO. Now it's kind of like you go and buy a new car from the dealership, and the car salesman is incentivized to sell the car for as much as possible. And as soon as you drive it off that lot, it's worth considerably less than when it was in the showroom, usually for thousands. Now, idea two. Brokers, research firms, and other Wall Street institutions are also more likely to issue buy recommendations as opposed to sell because they don't want to get in each other's bad books. Now, they aren't independent, or most of them aren't, and they are biased because of this. Idea three. They also want more money in the system, and contrary to popular belief, most of Wall Street actually make more money during an up market. They make commissions on all the transactions, and more transactions occur in rising markets. So everyone wants more money in on the action. Think about yourself. You might want to go and move money from this investment and take it out and then put it over here because you think here's a better idea. And during a down market, money leaves the stock market and it doesn't come back until people start feeling more safe. And so there's less commissions and less money moving in the system. Idea 4. The stock exchanges also have more controls around halting and controlling the decline during sell-offs. But there's almost no controls around stopping excess overvaluation, which was the case in Cathie's fund in 2020. Bubbles are more likely, but they just try to control the pop. Now, that helps to perpetually overinflate the stock market and give this perpetual optimism. And it's literally like during 2008, all the bankers and going around with a forced smile on their faces while literally the world burns around them. Now, your favorite YouTubers and TV commentators are bad for this too. Now, they hype up their favorite stock picks, get others to buy in, and what does that do? Well, it creates more demand. And the price rises with enough of that media reach and enough other investors jumping onto that idea. Now, then the stock price starts to rise. And those that bought early are reinforced that they made the right decision. And now other investors start to see the hype, they start to see the price rising, and they take that for an indicator that they must be right, and they buy it as well. They have that fear of missing out and they jump on. Now, the most potent example of this was GameStop. But that went to silly heights because of the short positions, which then forced a short squeeze. But as soon as that investor sentiment changes, it doesn't take much for the bubble to burst. And it happened with GameStop and it happened with Cathie's fund in 2021. Now, how can you prevent this? So the 3-step framework. Now, it's the same framework that Warren Buffett uses to actually assess the managers of businesses he wants to buy into. He considers the managers of the business he buys into as entrusting them with the money he gives them and trusting them to grow it over the long term. Now, the big question here is, can I trust them? This is the question. Now, it might seem a little bit ephemeral and a bit hard to answer, so I'll break it down into these 3 steps. So 1, candid. Are they open and honest? There's some ways to think through that. Are they openly discussing failures, or do they hide failures with no explanation that makes rational sense? Do they take ownership for those failures, or do they blame anyone and anything else but themselves? Do they communicate in a simple and easy to understand manner, or do they communicate in complex and difficult to understand manner? So using technical jargon and things like that. And if you're interested in how to apply this framework to stocks, I have a PDF version breaking down specific green flags and red flags of management, plus heaps of other resources. They're free. It's part of my mission to help other stock investors like you by sharing what I've learned. Click the link in the description to check them out. 2, are they aligned with me? So how do they make money from this or money from me? Do they make money from the short term or the long term? Do they make money from performance only, or no matter what, they get a cut? So the old Wall Street fund fee structure was based on a 2 and 20. So they would earn 2% of anything that was in the fund, any money, and then they would earn 20% commission on anything that they made. But that means that they also got paid 2% when there was negative returns. And that's one of the big reasons the majority of funds can't outperform the index. So what does good actually look like? Buffett set a fund up in the 1950s called the Warren Buffett Partnership. And this was before he'd bought and started to run Berkshire Hathaway. So every year he needed to perform 6% per annum. So if they had a bad year, he wouldn't get paid until he'd actually caught up to what he should have given him in that 6%. And then if we're up to the next year, providing that as well. Then once he'd reached that 6%, he would then earn 25% on anything above that. So for every 4% of returns above 6%, he would make 1%. So he needed to make 14% just to match the fund's 2%. And he had the majority of his net worth in the fund as well. And he had skin in the game. So these are two big indicators of good alignment. Putting your money where your mouth is and only profiting when you do. That's what good alignment looks like. And that's what you should be looking for. 3, rational. Are they rational with decisions? So contrary to popular belief, forecasts are not a good sign. Forecasts should be imprecise and vague about the outcome because that's what the future is. Valuation is imprecise and you can be vaguely right or precisely wrong by spending hours and hours just in spreadsheets. Now, that's not to say that they shouldn't be backed up by data and they make logical sense. But if you hear someone say it will 15x in 5 years, your alarm bells should be ringing. Hearing something like, we expect moderate growth in this sector. We've seen 30% year-on-year growth in revenue for the last 3 years, with profit margins increasing and customer net promoter scores improving. Well, that's a nice update and it provides accurate, up-to-date information without milking the data for all it's worth. At the end of the day, you need to think for yourself because if you let other people or the stock market's price make your decisions for you, they control your money. And they always will until you do something about it. In this next video, I break down how to buy stocks long-term without regret by using 7 tactics you can implement today. You can check it out here.